So hi Rosa, how are you doing?
Hi, Sweta. It's actually a rainy day here in Zurich, but yeah, beautiful day anyway.
Great. So before we begin, I would like to give a brief introduction of your prolific profile to our readers. So Rosa has extensively worked for top financial institutions in Europe in the areas like private banking and wealth management before becoming an investment independent advisor. She worked at Credit Suisse over a decade as the head of sustainability and impact investing. She is also a TEDx speaker where she talked on the topic like contributing to change through impact investing. So if you haven't yet watched the video, I highly recommend you watch it because it contains highly interesting topics and the links between investing and social impact. She's also an ardent advocate for quality education through NGOs like World Fund. And lastly, but not least, she's also our beloved columnist at Viva Most, where through her bi-weekly series, she debunks the investment jargon for our readers. And it has proved to be the most popular and most read series on our website. So Rosa, welcome. And thank you so much for taking time to talk to Viva Most today. And I can't possibly be more excited about all the information and knowledge I'm going to gain from this conversation.
Yeah, thank you, Sweta, for first of all for the beautiful introduction, and then second for giving me this platform, because I think what we are doing, trying to make investing a little bit easier. It's extremely important. As you were just mentioning in this column, Investing Made Easy, we just want to say to people, it's not this rocket science that they're telling you. It's quite straightforward. Yes, requires some attention, but we can do this together. And I'm very happy to have this platform here and also this conversation with you.
Great. So let's be honest. I love money, and people love money. Who doesn't love money? And it's always good to know that if we could make a little extra money through investments. Of course,
Yes.
people like Warren Buffett, the giants like Warren Buffett, have proved that with clever investments, you can become rich beyond your imagination. So yeah, investment is a very sought after topic, but it is also an elite subject, perhaps because of the jargon or combination of formulae and numbers. It always confuses to people like simple people like me. And also there is involvement of risk, which makes the subject even more fatal. So average people would think maybe I'm better off with savings rather than risking in investments. So why do you think people are so scared to learn about investment? And does gender really play a role in risk taking?
So I think that we have something innate in our being simply human beings. So what happens is that we have more fears of losing than we have will to gain, and this is material. You can read a book from a professor that is called Professor Kahneman, and he wrote a book. It's about thinking fast and slow. Is super fantastic. It's about behaviors. And what happens is that he was trying to do an experiment and was trying to propose a bet to people.
Okay.
And the bet would be we toss a coin, and if I win, you give me $10. And if you win, I give you $10. From the statistic, from the probability theory, this is a fair bet. It's 10 versus 10, 50% of possibilities. Actually, people would not take this bet. They would not feel it's fair. It would take up to getting to a point of 2 or 3 to 1 to get the bet. Basically, people would only take the bet if when they win, they will win 25, and when they lose 10. So they actually, as human beings, what happens is that our brain allows us to risk only if really what we can gain is much more than what we can lose, which is obviously not possible in reality. And that's actually what happens to us. And they could be men or women. This is simply in our brain. Then you also have to consider the fact that women for and we're not talking about hundreds of years, we're talking about thousands of years, in case million years. As women, we are protecting the house, we are protecting the kids, and the men are the hunters going out. So obviously, not only as women, we have this kind of human being moment of let's say prospect theory, that is the theory of Kahneman, but we also have the fact that we want to protect the future. So we are risk adverse more than men. So this means that in some cases we prefer to to have something sure today than something that we don't know tomorrow. So like having one egg tomorrow instead of having the chicken the day after tomorrow. So that's a fact. Now when you look about the difference between savings and investing, what people don't understand sometimes is that it's not that if you save, then you will have the same purchasing power tomorrow. The problem with saving is that sometimes you lose the purchasing power tomorrow. So it is not about, having a situation in which you are sure that you will have the same amount of money and the same purchase power the day after tomorrow. It's you're risking losing because of the inflation simply. So you're losing purchasing power. So the important thing is understanding how to compare the situation and make the right decisions. In some situation, actually, saving may be a good thing, and the good thing because you have, for example, a short time period. Let's say that you want to save because this month, next month, in 3 months, a certain amount of time of money, because you want to buy, I don't know, clothes or shoes or something for your kids, and this will happen in 6 months time, 7 months time. When the time period is short, the risk of losing the purchasing power is very small, because inflation doesn't work that fast. So if the timeline is very short, then savings may be really the right thing to do. If you are talking about investment horizon or an horizon, a timeline that is longer than 1 year, then you have a risk of losing purchasing power. Then it may make sense to invest. And then when you decide that you want to invest, then obviously you need to check, your risk profile, when you will need the money, what's happening around, and then invest properly so that you can reduce the risk.
So it's more about time. It's depending upon when you actually need the money than
exactly. So no one can say is better saving or is better investing, because it really depends on your time horizon and what you need to do with that money, and etc. etc. So it's a decision that needs thinking. We also need to consider some circumstances that we have today and we didn't have 10 years ago, we didn't have 20 years ago. And you also need to consider where you are. So let's say that I was, I don't know, 40 years ago in Italy, and I would leave my money in my cash account in a bank. So I just save and put it there. So instead of putting under the mattress, it's in a cash account. Still, because of the situation and the level of the interest rate, I would receive, some interest on my cash account that would be in the level of, even 6-7%. So at that point, when I was comparing savings to investing, I need to find investing that would produce more than 7%. Otherwise, why do it?
Yes.
Today, the situation that we have today, in Europe and in Switzerland, even, it's particularly different. We have interest rates that are negative, actually. So if you're lucky, you go to a bank and you have your cash account at the bank, if you're lucky, you don't pay, but they're not paying you anything. So they're not paying you an interest rate on those on this money. Is zero. So the comparison that you do when you do savings versus investing is 0 versus something. So it really depends on, you know, from a macroeconomic perspective, where we are, from the country perspective, where we are, and what you need, and which is your timeline when you say it's better saving or it's better investing. Now, if we really go back to really the words, before investing, you need saving. So, you know, if we consider saving simply putting aside some money that you don't spend today, this is the first action that you need to do. And then you can decide what to do with this savings. And then you can simply say, I don't do anything. And then they say savings. Or I do something so that in the future, I can have either the same purchasing power or even more.
True. That's an interesting way to put it. What exactly do you want your money to do?
Exactly.
So when investing, the experts always advise that one has to diversify. So what exactly is diversifying, and is it worth diversifying in present situation where a catastrophic pandemic has impacted all industries and countries alike?
Okay, so diversifying is very simple, is don't put all your eggs in a basket. So let's say, for example, that you want to start a business and you decided you want to sell lemonade in front of your house. So you can decide that you just squeeze the lemons into some water and you sell it. And you can be very successful because all your neighbors like your lemonade like you do, okay? Or it can be that, you know, your neighbors don't like lemonade. And then it's a disaster because you have spent money in producing the lemonade thing and you don't sell anything. So how do you reduce that risk of disaster? You, instead of selling only lemonade, you produce mint tea. So at least you have 50% situation in which there may be some neighbors that like mint tea if they don't like lemonade, okay? What can happen? So this is the diversification. Diversification means reducing the risk of your action. In this case, we are talking about investment, but it's about everything. By, you know, doing something, by entering, you know, either a business or buying a different investment that allows you to reduce the risk in case of negative scenarios. Now, the COVID situation is exactly that, is a negative scenario. So imagine you had only one investment, and this investment was, you know, travel agency. Okay. During the pandemic, you know, we realized that traveling has changed, and will not go back to what was before. So you would have lost a lot of money. Okay, depending on which type of travel agency and etc., more or less. But you know, in some cases, a lot of money. Instead, if you had both, you know, one investment in a travel agency and one investment in, I don't know, Zoom, for example, already you would have covered some of the risk. Okay. So what happens with diversification? It helps you, you know, reduce the risk in case of negative scenarios. And you know, definitely COVID is one extreme case here.
Yes. I come from a non-economic background, and you're really making it very simple for me to understand. So
beautiful.
Tell me, how can one identify that this can be a negative, or this investment can hit more badly, or this investment can gain more in near future? How can one identify the difference?
Okay, so when we talk about investment, we talk about a series of very different things. Okay, so investing is putting your money into something, and that's something maybe you participating to the capital of a company, which is equity, for example, or you lending some money, which is the fixed income. And you know, the typology of the investment is your involvement. So how much you will be involved and how much are you risking with it. And so, and this is one of the tools, so which type of investment to do, that allows you to understand how much risk you take. Because if you get into the capital of a company, you can risk everything, because if the company goes bankrupt, you go to zero, basically. Your money doesn't have any, you don't get any money back. While if you go for a bond, so if you lend money to a company, even if the company goes bankrupt, it may happen that, they sell their assets and they can pay you back the debt, because you're, favored in that way. So this is one level of consideration that one has to take when deciding how to invest. The second level is really the content of the investment. And then we were talking about sectors before. We're talking about the sector of let's say traveling, and the sector of let's say the digital economy. And there are, in our real world, there are a lot of sectors. Depending on the classification you have a lot of sectors. You have from agriculture to chemicals, for example. So what happens is that when you make a decision as a portfolio manager, for example, as me, what you try to do is that you try to predict the future, try to say, okay, what I believe will happen in the future, and depending on what I believe will happen in the future, I decide in which sectors, which countries, which type of instrument to invest. So this is what happens. You try to create scenarios. You try to say, for example, now we are in the situation that we never expected. We never expected that the economy would be so disrupted, and we don't know what will happen. What I'm doing as an investor, I'm trying to think what will happen tomorrow, so that I can invest today, so that I invest in the direction that I believe the world would go. So I don't think, for example, that despite now we are trying, we are going back slightly to normality after the lockdown, we are traveling a little bit more. I don't think that we will be traveling again as we traveled before, for example, for business.
Business, yes.
Because I realized myself that, we can do virtual meetings. I don't need to go to New York to meet my business partner. I can talk via Zoom. So probably instead of going, 5 times a year to New York, I will go once. And this will change. This means that, the industry of travel will change. It could happen that, part of the traveling industry, the ones that work, for example, locally, they will work more. Because, for example, in Italy, now what everybody is telling is that because the economy is so down, let's not travel anywhere else. Let's stay in Italy. Same thing is happening in other countries. So depending on where you position yourself on the traveling side, you may do more business or not. So my investment decision would be, for example, not to invest in aviation for long haul, but more invest in local distribution, or investing in those things that I believe will succeed in the future. And what I believe will succeed in the future is those companies that work with the supply chain. What we experience, for example, and it all comes back to reality and building scenarios. We realized that, we miss toilet paper in the supermarkets. The reason why we miss toilet paper in the supermarket is because supermarkets were used to, stock some toilet paper, and then if it finishes, you call the producers and they bring. And then you realize, okay, if I call the producer now, they can't bring.
Yes.
Because it's lockdown. So we realize, okay, then we need to have a different way of doing supply chain, a different way of communicating, maybe different distributors. So all those companies that are reinventing the supply chain, or or the logistics, are actually those companies that will thrive in the future. So this is what you try to do when you invest, kind of predicting a little bit the future and positioning yourself based on what you believe will happen.
So when you predict the future, what kind of resources or tools do you use? Do you also participate in these studies?
I need to answer differently to this question, depending if you ask me as, representation of all the professional in the investment industry, or as if you ask me as Rosa. And let me explain this. Because what happens as Rosa is that Rosa doesn't do all the analysis by herself. If I had to spend all my time, analyzing, the sectors and everything, and then the securities, and then talk to people, it would be too much. But there are investment professionals that work exactly on those scenarios. So what they do is that, first of all, they look at the past, and they look, okay, what happened in the past when there was a shock that was similar, what happened? And then they try to, position to the future. So there are a lot of, companies that actually do exactly this. So they have a look at the past, and then they try to transpose to the future. And what a lot of investment professionals like me do, we may read what they produce, and then we create our own opinion. And if you Google, for example, if you go and Google kind of scenario analysis, for example, you will find this kind of scenarios. They will tell, okay, we believe that if this happens, this will happen. And now let me go more into details of capital market assumption. So when you create a scenario, you say, okay, if, I don't know, interest rates go up, what happens to the companies? Capital market assumption is really translating this qualitative theory into numbers, into saying, okay, if interest rates go up, equities will perform 5%, fixed income will perform 3%, in US will perform 3%, and real estate will perform that percent. So it's transferring those scenario analysis with the probabilities into potential yields, profitability, and then you can use those yields to create your portfolio.
Oh, okay. That's interesting.
Absolutely. And as a professional or as an investor, usually what you should do is you should read more than one so that you can compare, because there could be different opinions.
Cool. Yeah, definitely. Back to investing. Can a person with the lowest income or a person who is working on hourly basis without any fixed income can also invest and get benefited out of it?
Just going back, to the real important thing is that what we earn from our activities is to sustain ourselves. Okay, so independently of which is the type of income that you have, the first thing is you want to sustain yourself, and you want to sustain yourself for today and for tomorrow. Because because you don't know what will happen tomorrow. In COVID has taught us that it could be that people may lose the job. So what you want to do is, though, you want to be sure that you have enough money for today, and let's say for the next 3 to 6 months. So in case you lose your job, you have the possibility to stay, to survive and also not panic. First thing is, independent on where your income comes, to put aside a little bit, which is for the worst times in case of negative scenarios. But once that you have put this aside, once that you have identified, okay, how much money do I need for the next 3 months or the next 6 months? Once that this is aside, and is your savings, is your parachute. Once this is aside, then you can have a pocket where you put money that is not needed for the next 6 months, and then can be put into investing. Okay. So the point is, just be sure that you cover your needs and the needs for the foreseeable, let's say, future, so that you are calm in when you make decision. Because the worst thing that can happen is that you have to make decision, when you don't want to make the decision. For example, invested in something, and you need the money earlier than what you thought, and then you have to sell at the moment that you don't want to sell. So this is what you want to avoid. So you want to always have a cushion of safety on your side. And then once you have covered the cushion, it's good to have a pocket where you slowly you can put everything that is over and invest with a longer term. And then what can happen is that you can create this pocket of money, and then okay, this pocket of money could be the one for the next 12 months, and then you invest very conservatively for the next 12 months. And once that you have a little bit of money that covers the 12 months, then you can consider, okay, then let me have a pocket which is more long term. So you can build slowly your retirement, for example.
That's nice. Actually, it's an excellent suggestion that to have a combination of both savings and also investments. So
yes,
climate change and awareness towards social issues have certainly brought impact investment into prominence. And based on recent research, the Swiss sustainable investment has increased by 83% from 2017 to 2018. And the current size of the global impact investing market is at $502 billion, of which 21% comes from Western, Northern, and Southern Europe. The interest is rising and the participation is also increasing. But unlike other companies, we can't determine the success of companies based on environmental and social issues to be as easy. And this can be a negative indicator for investors. So what are your thoughts on it? How can we increase the interest of investors to be more socially responsible in investing?
So, I mean, my personal opinion is that sustainability and impact investing is nothing else than common sense investing. So we all know that if by 2030 or 2050, depending on the timeline that you're looking at, if we do not reduce greenhouse emission, the Earth will have a temperature that will be so high that a lot of bad things will happen. Yeah, and those bad things include destruction of entire cities. Those bad things include, a lot of animals not existing anymore. So we're not talking about, we don't know what will happen. We know what will happen. So now we have the information and we have the data to avoid that. So this is simply common sense. We need to go into that direction. What has happened in the past is that people thought that if you go into that direction, you are not getting the same returns that you get if you invest in other things.
Yes.
But this is not intuitive. This is not intuitive. Everyone or a lot of people are trying to find a solution to this climate change. Those ones that will find the solution will earn a lot of money. Will earn a lot of money because governments will invest in it, because institutional investors will invest in it. So now what we have seen now with the COVID is that people that had invested in sustainable and impactful solutions actually have gained much more than the others in this period. So now we have the proof that sustainability and impact investing not only can earn the same as other investments, simply because you are trying to change something and you're making things happen, and you can do it with a profitable business. Also, in a situation of risk, actually they allow you to risk less. And this is extremely, extremely important. So I think, that actually COVID could have been or could be a catalyzer for a complete change. So we are seeing and we will see a lot of inflows in sustainability and impact investing. And not only, distinguishing it from traditional, from sustainable, what we will be seeing is that we will see a transformation. So I would expect that probably in 10 years, every investment will be sustainable, simply because that doesn't make any sense. So the point won't be, do you want to invest in sustainability? But the question will be, why are you not investing in sustainable things? Why are you investing in things that pollute? Why are you investing in things in companies that employ kids? Why are you doing this? Because this is, this will not be accepted by anyone anymore. So actually, it's a good time now to get into the business, because otherwise it will be too late.
Yeah, brilliant. And that can be the perfect answer for people who are facing peer pressure or negative influence on their investments.
What I think is that from a human perspective, it's extremely important to have peer pressure and indirect influence. We need to listen to the people that are around us. We always have to listen, because they may have good experiences, and we need collective conscience and then the collective understanding of things. So it's important that we collaborate on this. The issue happens when those people do not have the right information, do not have dated information. So that's why it's important to have a lot of sources to read, and also to create your own opinion. So I would suggest to everyone that has peer pressure, everyone that hears something like, oh, because I have it. I mean, I'm a woman. So sometimes people look at me and say, oh, Rosa, she's so sweet. She wants to save the world. And the point is not, for me is no, I'm a portfolio manager. I'm making money. So, but the suggestion is just inform yourself and read and create your own opinion. Your money, your savings, the money that you have, put together and want to invest for your future needs to go in your future. You want your money to contribute to the world that you want to see in the future. You don't want your money to contribute to things that you don't want to see in the future. Why would you do that?
True, true. That makes so much sense when you say that. Exactly, yeah. Also mentioned many times during our conversations and also in the series that you believe banks play the role of a bridge between people who have more money than they need and people who have ideas but no money. How seriously you think banks take sustainability? And has there been any development in financing social entrepreneurs? And how has the response been from the investors?
So banks have an important role. They are the bridge, and we have given, as society, we have given them the role, and they are really instrumental to the change. What banks are seeing a lot of clients going to them and telling them, I want to invest in those topics. So they had to build up both information, data, and solutions for clients. Sometimes it's a bit difficult for banks because they are usually, or often, they're very big. And when you have defined an investment process in a certain way with certain data, introduce new data or change completely your processes, it may be complicated, but it's happening. And it's happening for two reasons. One, what we said, bottom up, so clients asking. But the other thing, top down, you have seen, the UN coming out with the Sustainable Development Goals, but also the regulators coming in. So now it's kind of the new word of the moment is taxonomy. So the European Union came out with a taxonomy, and the taxonomy means the rules that banks have to fulfill going on in the future. So the European Union is asking banks to report about the sustainability of their solutions to clients. So banks will be obliged by the regulator to tell the clients how sustainable the solution that you're having is or not. And in particular about climate change. So there will be possibilities for all the clients, all the investors, to compare banks to banks based on the sustainability of their solutions. And this is, extremely important and will also drive the change. So banks, there are some banks that are doing better than others, some that are faster than others, but in any case, there is a lot happening. European taxonomy is one of the things. Another thing is, for example, the UN came out a few years ago with the principle for responsible investing, and last year with the so-called principle for responsible banking. So, for example, at the moment, I think, around, 200 banks are going into this certification of principle for responsible banking, and they will review all the impact that they create on society. And, banks are companies, so they produce, so they use energy, for example, they use, they have employees. So as companies, they have a certain impact, but lending money to companies, and they can lend money to companies that pollute, or they can lend money to companies that do not pollute, for example, and actually are using the money of their clients to lend also. And companies are also, and the banks are also influencer, because banks can educate clients and the banks can educate their actually service providers. So they are key in this transformation. And the regulators and the top-down influence from international organization is having an impact and will have an impact.
Wonderful. So how do you think the Swiss banks are faring?
I think, that when we look at Europe, definitely the sustainability, journey, or the impact journey is much more advanced in the Nordics. So if you look at Sweden, Netherlands, they're really much more advanced. And the reason being, a lot of their institutional investors, they're, really trendsetter in this, on this topic. But after them, I think, that countries like Switzerland, also UK, and Germany, we are, at this stage of, mid journey. So we're not as advanced as the Nordics, but, we are actually getting there. And you can see you just mentioned at the beginning of the conversation, Swiss Sustainable Finance, they are doing a lot. Geneva is trying to become the hub for sustainable finance and is hosting the UN in a lot of things. I mean, we have an history of being a country, hosting international organization, and this helps a lot. We are also in Switzerland, a country with a lot of entrepreneurs, and we have the ETH and the FPL, so those universities that actually are breeding entrepreneurs that are working a lot for climate change. So I mean, there is a lot happening in that respect that is actually better than the south of the world, because in some cases the south of the world is a bit, later in the journey than we are. And all over Europe actually is quite advanced in sustainability and impact compared to other continents. So compared to the US, for example.
Oh, great. I have been hearing a lot about Robo Investing, where a robot will help the human instead of a financial advisor. We just need to fill in few questions on the questionnaire, and it would create the financial profile or the investment profile for the users. How efficient are these robots? And if these are efficient, how technology impacts and will change the investment banking industry? And what's the scenario in Switzerland?
Okay, so I think we would need at least another 2 hours to talk about this. So I will try to, give you some hints, and maybe we can also have, more deep dive in at the moment. But when we talk about robo advisor, I think one thing is important to say is that it's not that we are having those robo that are thinking and deciding. Robot is nothing else than an algorithm. So basically, what happens is that as human beings, we recognize patterns. We recognize that, we were talking about scenario analysis before. We recognize that, for example, if interest rates raise, companies that have to borrow money will borrow less because interests are too high, or even if they borrow, they will have more cost. So this means that the profitability of the companies will go down. This means that, let's say, the equity markets will have lower yields. Okay, so this is something that human beings have observed. And the human beings use this observation to decide how to invest. So I know that if I think that interest rates will increase, I will invest less in equities because I think that they will suffer. So what we do as human, we create formulas, algorithm that simply replicates this thought process. Okay? As human being, we define, some formulas. And robo advisors are nothing else than these formulas. So basically, they are created by human being, but then at the end, you don't need any more Rosa that tells you, okay, if interest goes up, equities go down. We have a formula that does it. So we simply give an input, and then the output is defined by the robo advisor. So this is, I know, a very, very simple explanation, just to say that we're not talking, when we talk about artificial intelligence or robo advisor, it's not about, a brain that works for itself. It's simply patterns that human beings have recognized and have transformed in formulas. Now, when you look at robo advisors, there are different types of robo advisors, because in the investment process, so from the decision of which risk profile I have as an investor to which security do I buy, there are a lot of steps. So depending on which step of the investment process you substitute with a formula, with a robo advisor, then you have different robo advisor. So you have, in some cases, robo advisor just simply identify your risk profile. So instead of having a person that asks you, Sweta, so which is your timeline? When do you want to invest this money? Do you have kids? Instead of having a person, you have a form. And you fill in the form, and automatically behind there is a formula that tells, okay, Sweta has a medium risk profile. Okay, so this is already something that someone calls robo advisor because there's not a person behind. Or you can substitute all the other parts of the investment process. So for example, when you want to go from Sweta has a medium risk profile,
Mm.
which is the asset allocation. So how much equities, how much fixed income, how much cash does she has to have. So
Mm.
it could be Rosa telling you, or we could make a formula that from the risk profile goes to how much in each asset class do I have to invest. Again, the robo-advisor can also take other parts of the investment process. So for example, the security selection. Security selection is when we decide which security. So we may decide to make a formula that, we only invest, the formula says that you invest in equities that have dividend yield, or so they pay dividend more than 5%, only in this type of countries, and etc. So formulas that go on the security selection. So depending on which part of the investment process you're substituting formula, you're talking about different robo-advisors. Now, there are a lot of robo-advisors. I think the last estimate was they are managing around 1 trillion at the moment, on platform on robo-advisor. Obviously, I'm talking about any kind of robo-advisor. Some they are just doing, the risk profiling, some the security selection. 1 trillion is basically more or less a bit less than 1% of the overall assets that we have in the world, but it's still, a lot of money. Is growing, and the reason why it's growing is that obviously because you have less people in the process, you pay less salaries, so your costs can be lower.
Yes.
So now, when is it good to work with robo-advisor? It really depends, because first of all, you need to understand which part of the investment process has been, substituted by a formula. And second, you need to have a look at how transparent is the formula. So are they telling me how they are doing this or not? Because you don't want to have a black box. You don't want to have something you don't know how it works. And the third part is the cost, because if I'm going into a black box, then at least it needs to be worth, so the cost needs to be lower. In Switzerland, there are a few robo-advisors working. I mean, I can give you a couple of names. For example, the most known, I guess, are True Wealth. So this is probably the oldest one in Switzerland. It was founded in 2013. What they do is basically they substitute the part of the asset, the definition of the risk profile and the asset allocation. So how you distribute your money between different asset classes. So how to choose equity, fixed income, and real estate, for example. And the security selection, they don't choose the single securities, they simply invest in ETFs. So ETFs are the passive way. So they buy the full market, don't buy the single securities. Another similar, and the good thing about True Wealth is that they give you the possibility of choosing to invest in sustainable ETFs. So you have the possibility of sustainable. The second one created was, I think, and it's very similar to True Wealth, is Selma Finance. One special probably to mention now that is dedicated to impact investing or sustainability investing is Yoga. And what they do is that differently from what happens with True Wealth, they do security selection. So the robo-advisor chooses the securities. So this means really that you're choosing the security with the sustainability screening. They may be a little bit more expensive than True Wealth, but they do the single security.
How are they being used, or what has been the response from the users? Are they good enough?
So you have to consider that, I guess, that of the 1 trillion invested in robo-advisors, around 70% is in the US, because the US is where, a lot of people are using them. In Europe, we are a bit, it's slightly different, because people still see a value in the human being, eventually in the interaction. And also because the costs in the robo-advisors that we have in Europe are still high compared to what you have in the US. More or less, when a total expense ratio for a robo-advisor will go between 0.7 and 1% here in Europe, and when you have people behind it, you get 1.5%. So distance, this is my theory, is that distance is not enough, so people are still a little bit scared of investing in this a bit black box, even if the black box is created by human beings. So it's not not a robot as we can imagine it in the in the Star Trek films or stuff. It's just algorithms, but the response is still a bit slower than what we see in the US. So when we look at Europe and Switzerland, effectively we have a lot of institutional money, and we have a lot of money that is here since generation. So the quota here is quite small for the moment, but I think that's growing.
And why do you think the expense is different than the US when the work is actually similar?
And I think it's a question of competition.
Okay.
There are many competitors in the US. So the market is, when you have a lot of competitors, prices go down first.
Mm-hmm.
And second, you have assets. The more assets you manage, the lower you need to charge, simply because it's an effect of scale. As a manager, once that you have your own algorithm, probably managing 100 million or managing 300 million is more or less the same cost, but a lot of cost. So I think, it's a ramp up phase here in Europe where, managers need to, gather assets, and then, prices could go down.
Okay. Great. How do you think the investment industry evolved after the economic crash in 2008? And what's in store after COVID-19?
That's a very difficult question that you stole for the last. So I think, that is my very personal opinion.
Okay.
I think that the financial industry didn't learn the lesson in 2008. So there was a little bit of a mismatch between reality and the financial industry, and we tried to save it through central banks creating money and trying to save the banks, and the banks would have had to transfer this economic growth or this money to the entrepreneurs and to the companies, and this actually didn't happen to me. So what happens is that banks still work in a very similar way to how they worked in 2008, 2009. So what has happened is that probably some regulation have changed, so they have to report more. So a lot of transparency more, but not a lot of change from really the solutions that they provide. And this has created a situation in which we don't have really a lot of growth, economical growth. Now COVID is another shock. The situation that we are having with the pandemic is another shock. Is another situation in which a lot of the industries are suffering. And now what happens is that we can't save everyone.
Yeah.
So the situation now is slightly different, and I don't think that from an economic perspective we have passed the worst. I think that now we are in this phase in which we are trying to understand what's the new normal, and we will have probably in the second part of the year a little bit more of a crisis, because what we have seen is that a lot of people were losing the job temporarily and receiving some subsidies from the government. What we will see in the second part of the year and the beginning of 2021, we will see that some entrepreneurs won't make it, meaning that they have to close their shops or businesses. So this will be a crisis for everyone, and then we will need to understand which will be the sectors that will work better, and we don't know. Now, from a financial industry perspective, what I think is that there is a lot of FinTech around. There is a lot of options for digitalization. So what I believe will happen is that there will be a lot of cost cutting within banks. So a lot of people that are employed now from the banks will be let go, simply because a lot of the jobs can be substituted by this, by what we were talking about, by formulas, by by tools that can do things in a slightly different way, but they can do things. And all those people will need to find, a different way or a different path. But in every evolution, society will change and will go in the direction. So there will be more jobs probably in the digital industry, and less job in the financial industry. And I wouldn't be surprised if we will see more FinTech or independent, producers of financial technology ramping up, and see banks, or what we are used to see as banks, kind of, merging or changing very strongly their business model.
Okay. So you think there will be more and more fintech companies that can evolve from this crisis? Maybe entrepreneurs will be more concentrating on how to digitalize the finance industry.
Yes, I think there are already a lot, but there will be more and more. And what I'm seeing is that this fintech are concentrating on parts of the processes. The banking industry today is is a huge thing. They do a lot of things. So what I believe is happening is that the fintech are concentrating on the different steps, and they will be, take care and do those steps, better than a bank is doing. Now, what if in the future the bank will be simply the aggregator of the different fintech, or we will see banks reducing the scope of what they do? I don't know. But there is a contamination, and fintech are much faster than the global banks to move, obviously, because if you have 100,000 employees versus having 200, definitely there is a different speed.
Yes.
I mean, when you have 100,000 employees, we are probably protected by the government, but you are less efficient.
Yes, true. So yeah, thank you so much, Rosa, for your wonderful knowledge sharing. I definitely have learned a lot about investment industry, and I hope our viewers also have learned a lot. And it has been a pleasure talking to you.
It was my pleasure, Sveta, and I love our conversations, and they actually, when you have those conversations, you discover things yourself. So I'm happy to have this conversation, and to receive any question, if any, that happen through your platforms.
Sure. Thank you so much, and take care.
You too. Have a good evening.